With shares of Netflix coming into this Q2 print on a red hot tear, the question remains, how much longer can shares continue to outperform like they have, with shares being up nearly 40% year to date and up close to 100% over the past 1 year? We'll answer that question as we go along in this video. We'll take a look at their key fundamental metrics like revenue, like earnings. This company consistently gives us with strong beats across the board. They in fact also raised guidance for the full year in terms of revenue as well as free cash flow. So things are looking really, really good over at Netflix. On top of that, you're expecting revenue growth to accelerate. You're seeing strong operating margins also rising year over year. And then you're on top of that, you're seeing your free cash flow essentially double year over year. So things are looking quite good over at Netflix, at least fundamentally. And then from a technical perspective, you're trading or you're hugging the top end of your channel. We'll see where shares can present a pretty attractive buying opportunity, at least if you're stepping into shares of Netflix for the first time. Hey guys, hope you're doing well out there. We're going to kick things off with Q2 tech earnings, as we always do, by taking a look at shares of Netflix. This one tends to report their earnings slightly sooner than the other mega cap techs, but you'll have the other companies follow through maybe in a week or so, and we'll be sure to cover those here on the channel. Like we said, shares of Netflix have been on a red hot streak over the past year, and that's pushed up the valuation, now trading nearly 50 times a forward earnings multiple. We'll also take a look at this valuation on a historic basis as well. But before that, we have to take a look at their double beat, with revenues coming in at 16% growth year over year, nearly $11.1 billion. That again, like I said, beat revenue expectations. You also had a Q2 beat on the bottom line by nearly 12 cents. This company tends to come in with a double beat year in and year out. On top of that, they did mention, we'll jump to the guidance a little bit. They did mention Q3 revenue guidance of 11.53 billion. That was against a consensus estimate of 11.28 billion. So again, analysts on Wall Street continually underestimating this company's ability to grow those top line numbers. Now that the fact that they don't report subscriber figures, analysts probably have a harder time kind of gauging exactly where that revenue figure will fall through. But in this quarter, it came in slightly higher because you had that full quarter of price increase flow through. You also had, again, continually adding new subscribers. You had a very strong content slate over at Netflix in the first half of the year. And so again, analysts expecting roughly 15% revenue growth. Netflix telling you they're going to grow faster, closer to 17%. They also are coming in with a Q3 guide beat on that bottom line as well. So those are promising signs. You also got another raise over at Netflix on the fact of your full year revenue forecast, now up to 43.5 up to $44.5 billion. Pardon me, that was the previous guide. Now that's been raised up to 44.5 up to, call it, $45.5 billion. So basically adjusting both the lower and the upper end by about $1 billion. Again, those revenue figures are adjusted a little bit due to the fact that they're seeing healthy member growth and ad sales, considering the fact that they now have a very, very strong ad business. But also you're seeing a reflection of the weaker US dollar, considering the fact that Netflix does a fair amount of revenue overseas. That weaker USD does give them a tailwind, at least into the remaining half of the year. So things over at Netflix looking really good. You got a double beat. You also got a raise on Q3, and then you also got a raise on full year revenues as well. And so that's one of the reasons why shares have performed so well over the past couple of months, even the past couple of years. But what that's led to is a rise in the valuation. This company's valuation now trading at a historically high level, even on a price to sales basis. I have a 10-year chart pulled up, and you're trading at about 13 times a price to sales. And even historically for Netflix, that is as expensive as it gets. And even if you ignore this massive dip in 2022, where shares really shouldn't have fallen by nearly 70%, even if you take the average over the past couple of years, I mean, you get as high as about 10, maybe 12 times a sales, and then you trade back down. And so trading at about 13 times sales, even for Netflix, is historically pretty high. On top of that, you're pushing a forward earnings multiple now close to 50 times as well. So keep those things in mind as we walk through these figures. I mean, they're fantastic, but you have to paint that into perspective of that valuation as well. Now, as we saw, Q3 revenue forecast expecting roughly 17% growth year over year on that revenue side. That would be accelerating revenues from same time last year, where we saw nearly 15% growth. And then on top of that, you're seeing operating margin leverage begin to kick in. A year ago, operating margin was about 27%. In this most recent quarter, they got that up nearly 7 percentage points, up to 34% as well. So things looking good over at Netflix. They did mention the fact that operating margin will decline in the upcoming quarter down to 31%. Some of that is due to the fact that this company tends to amortize a lot of their content in the second half of the year. They also have a rather second half heavy content slate in 2025, and so you'll see a bit more spend on sales and marketing in the back half of the year. Tends to affect margins a little bit, but clearly that's not going to affect growth. In fact, all of those things will just simply be bullish over at the top line growth over at Netflix. On top of that, I want you to take a look at the free cash flow, up to nearly $3 billion. That's in a quarter. Last year, same time, we were roughly $1.2 billion in terms of free cash flow. This company is churning out absolutely huge amounts of free cash flow. In fact, they went ahead and raised full year free cash flow guidance by about $500 million up to $8.5 billion. And we see that's being used in terms of reducing those shares outstanding. This company now executing pretty meaningfully on that buyback, and we're seeing that follow through. In terms of their different regions, you're seeing over in the United States and Canada growth continuing to stay strong at roughly 15% quarter over quarter. You're seeing very fast acceleration. They did mention some of that is due to the fact that this was their first full quarter of that price increase flowing through. Last quarter, we didn't have that price increase in there. Overall, you are seeing those revenue growths slow down a little bit from a year ago, something you would expect as the consumer base and the customer base continues to grow larger over at Netflix. In terms of EMEA, you're seeing similar trends where the revenue growth is moderating a little bit, but still holding quite steady at roughly 16%, up to nearly $3.5 billion in Europe and Middle East. The Latin America market is where they are beginning to slow down quite a bit, as you're seeing revenue growth slip into that single digit range. When you factor in foreign exchange neutral, you are still seeing 20% growth, but that growth is slowing down quite rapidly from same time last year. So you are slowing down on the Latin America side, but that is being more than made up for over in Asia Pacific. Because what I want you to notice is a year ago, Asia Pacific was about $1 billion and Latin America was $1.2 billion. So the Latin America market was about 20% bigger than the Asia Pacific market over for Netflix. What you're seeing in the most recent quarter is they're basically both running even at $1.3 billion a quarter. So probably my guess is next quarter, you'll actually see the Asia Pacific revenue surpass the revenues over at Latin America. That's largely because you're seeing rapid acceleration of growth in the Asia Pacific region, up to nearly 24% in the most recent quarter. So despite this company slowing revenue growth in one region, they are making up for that and more in another region. Some of that could just be due to the timing of their content. Maybe it's hitting a little bit better with the Asia Pacific consumer rather than the Latin America consumer. Could flip maybe down the line, but you are seeing growth over in Asia Pacific hold actually really, really strong. That's a bullish sign for Netflix moving forward. And then again, the bread and butter remains United States and Canada. That remains continually strong for this company. Now, from a statement of income perspective, I mean, things are looking good over at this company. $1 billion of top line revenue. That was about $1.5 billion higher than same time last year. On top of that, you're seeing your cost of revenues just marginally tick up from, call it $5.2 billion up to nearly $5.3 billion. You're also seeing growth on your sales and marketing, tech, R&D, general administrative, growth across the board. But I mean, you're not growing rapidly over at Netflix, at least those expenses, and that allows your operating margins bump up nearly from 27% up to 34% in the most recent quarter. And again, like we said, they will see that tick down in operating margin in the second half of the year, likely because sales and marketing will ramp up a little bit more. You also have those cost of revenues. Anytime this company produces more content, those cost of revenues tend to increase relatively in line as well. So continue to expect that. But all things considered, I mean, $3 billion of net income in the most recent quarter. That's strong increase, nearly 50% increase from same time last year as well. And you're seeing your shares outstanding tick down on a year-over-year perspective, also on a quarter-over-quarter perspective as well. So when we get to the cash flows, you'll see this company is now executing quite meaningfully on a share buyback. In terms of the balance sheet, nothing to be overly concerned with. Certainly not a great balance sheet, especially when we take a look at other balance sheets later in earnings season, like Google's and Microsoft's. I mean, Netflix is somewhat inconsistent because you do have about $8 billion of cash and cash equivalents. That is balanced off by roughly $14.5 billion of long-term debt. But a few things I do want to point out with this balance sheet, first of all, is they did wipe out their short-term debt, which was about $1.7 billion. They did also sell off some short-term investments in the most recent quarter. We'll see that when we get to the cash flows. My guess is likely to actually pay off that short-term debt. The other thing with Netflix is you have this nearly $32 billion worth of content assets. This is really the moat over at Netflix. A lot of their balance sheet is tied up into these content assets, which if you, in my opinion, were actually selling these in the open market, you'd probably put a hefty premium on these content assets, considering this is basically Netflix's defensible moat, something that no other streaming company or media company can really match or produce. And so a lot of their assets are tied up into these content assets. And so that's from a balance sheet why you're seeing a discrepancy in terms of the cash and then also the long-term debt. Generally, we like to see companies that have more cash than debt on their balance sheet. But again, with Netflix, we'll give them that pass considering a lot of their cash gets tied up into these content assets. So again, all things considered, you're also printing huge amounts of free cash flow. So you're not overly concerned about the debt levels over at Netflix, at least at the current time. From a cash flow perspective, we pulled down an operating cash flow figure in the most recent quarter of $2.4 billion. Like we said last year, it was just at 1.3. So you nearly doubled your operating cash flows year over year. On top of that, your purchase of property, plant, and equipment isn't an overly large number, at least compared to your operating cash flows. It did increase meaningfully year over year, but for about $2.4 billion worth of operating cash flows, roughly $150 million in purchase of property, plant, and equipment, otherwise known as CapEx, isn't an egregious number, especially over at Netflix. And so that leaves them with about, call it $2.2 billion in the most recent quarter in terms of free cash flow, and they have a lot of room to play around with that. Well, they do a nearly $1.6 billion buyback in the most recent quarter. And one thing I do want to point out is last quarter, they actually had a far aggressive buyback of $3.5 billion, despite printing roughly about the same in terms of free cash flow. They bought back shares far more aggressively. And one of the reasons for that is because shares were declining previous to the last earnings report, and shares were trading close to about $1,000 in terms of an average basis. And so the fact that Netflix stepped in more aggressively in the previous quarter and bought back shares at a lower price, especially when shares were trading down, that shows that the CFO and at least management have a pretty good idea in terms of when shares are at a bargain, and they tend to scoop up more shares aggressively on any major dips. That's exactly what you want to see from a management team and a well-rounded company that's putting their free cash flow to use when it's most effective. And so you had that $1.6 billion buyback in the most recent quarter. You also paid off that debt to the tune of about $1 billion. And then, like we said, they also sold off some of their short-term investments for about $1 billion as well. So all things considered, I mean, you added some cash onto the balance sheet over at Netflix, you paid off some debt, you continue to execute on a buyback, reducing your shares outstanding. I mean, the only thing left for this company to do is probably pay off a dividend. My guess is that won't happen anytime soon, simply because they're growing far too fast. They have enough to invest in that to the point where they don't feel the need to return excess cash in the form of a dividend. Certainly, I think that's the prudent thing, considering the fact that you have shareholders rewarding this company for continually putting out great pieces of content, continuing to drive up viewers and drive up engagement as well. They did mention in the press release that viewing time was up about 1% year over year. Consider the fact that this company in 2025 is loading a lot of their content in the second half of the year. So you'll likely, in my opinion, see a much stronger second half, considering the fact that you have Christmas Day NFL games, you also have some boxing matches in the third quarter, and then you also have a new season of Stranger Things that's coming later in November as well. So you have a very strong slate of content over at Netflix, especially in the second half of the year. Now, from a technical perspective, if you've owned shares of Netflix over any length of time, I mean, give yourself a pat on the back. It's been a relatively bumpy ride over a longer time stretch, as you've had to go through some major drawdowns. But in the more recent, call it 1 to 2 years, things have been looking pretty solid over at Netflix. You've been channeling in a pattern of higher highs, higher lows. You don't actually come and retest the bottom end of the range all too often, maybe about 1 or 2 times over the past 2 years. So when you do have a deep pullback in Netflix, which look, at some point will come, maybe not in the next month or the next year, at some point you will get that deep pullback. That's when you step in aggressively, because like we said, you don't get these kind of pullbacks ever so often. Now, in my opinion, the better time to step in and buy shares of Netflix probably is when you're coming closer to the middle of the channel. In my opinion, that's where you made your previous set of highs, somewhere around $1,000, maybe as high as up to $1,100 per share. So you pull back into this $1,100 range. That's probably where you're beginning to step in and allocate meaningful amounts of shares to your Netflix position. Even at these levels, I mean, you are, call it roughly 4 or 5% off your all-time high. So if you're overly excited wanting to step into Netflix, I mean, you could nibble at these levels, but I would actually wait for deeper pullbacks. That's when your valuation also becomes a little bit more attractive, like we saw from a price to sales perspective. Things are looking quite expensive over at this company. I mean, they absolutely deserve it because the results are fantastic, but no doubt about it, the street is pricing in a lot for this company, and despite great results, you're seeing shares trade off about 2% in the after hours. So just keep that in mind. A lot of future growth and earnings have been baked into shares of Netflix. At this point, you get pullbacks, I guess, south of 1100. That's when you're stepping in and allocating to your Netflix position. No real reason to sell up here with shares of Netflix. I mean, there's nothing in this print that has me concerned. If anything, the valuation itself is getting stretched, but valuation wouldn't be the sole reason for me to step out of a position, at least one that I'm already in and one I do like for the long term. That was my take on shares of Netflix. A fantastic quarter for a fantastic company. It's just the valuation that you have to watch a little bit. You get pullbacks south of 1100. That's probably where you're stepping in on shares of Netflix. Thanks so much for watching. We'll be back again with more tech earnings coming later next week. And then I think the majority of tech earnings ramping up the week after that. Stay tuned here on the channel. Hit that subscribe button if you haven't already. As always, thanks so much for listening. I'll catch you guys in the next video.